Today we're going to be answering a question from Oyungsky. He asks about a specific strategy, backtesting a strategy. So the idea is, what if you invest in the top 20, and I assume he's meaning here by market cap, meaning if you take the number of shares outstanding and multiply those by the price per share, that tells you the value, the total value of the entire business. So right now, Apple, I believe, is the #1 market cap. It fluctuates between Apple and Microsoft. Nvidia was briefly the most valuable company in the world, but it's been doing pretty poorly over the last few weeks. So I believe Apple's the largest. His idea for a strategy is to take the top 20 market cap and then rebalance those top 20 portfolio positions every quarter, much like the S&P 500. And he says, please compute going back to 2004, ? And so I'm gonna do this strategy. I'm actually going to do it all the way back to 2003. The S&P 500 is 500 stocks weighted by market cap. So in that index, Apple is about 7% of the portfolio. Microsoft is also about 7%, etc., etc. And as you get smaller and smaller, the weighting gets smaller and smaller as well. So in this backtest, we're going to be doing a top 20 portfolio, which is going to be equal weighted. So this is a little bit like a combination between the S&P 500 market cap weighted, in that you are going to be focusing on only the largest businesses. However, you're going to be equal weighting those. So Apple is actually going to be slightly underweighted at 5% instead of 7% in the normal index. Microsoft will be underweighted as well. But then when we get down to others in the top 20, like Berkshire Hathaway, instead of it being, say 2% of the S&P 500, in our strategy, it's going to also be 5%. And then we're going to end up selling the winners each quarter and buying a little bit of the losers. And then we'll also add companies as they go into the top 20 and sell them as they fall out of the top 20. So I'm going to build this using Portfolio 123, which is my favorite backtesting tool. The guy that owns it, his name's Marco, actually offered to allow me to have a free subscription, kind of as a way to sponsor the channel. So I'll probably be doing a couple videos for them. But if you're interested in this software, check it out. Absolutely, bar none, the best data software that I use. So we're going to start off here with a dynamic weighted strategy of 20 positions, and we're going to rebalance this every 13 weeks, which is once a quarter, just like he mentioned in his comment. We're going to be using the S&P 500 as our universe. The benchmark that we're going to show is the S&P 500. And then for the ranking method, I've actually built a ranking method here, which is market cap, and that's going to basically sort everything by the highest market cap. The higher, the better. And then we're going to buy any company as long as its market cap ranks in at least the top 20 out of 500. So that's going to be our buy rules. We're going to sell whenever that is violated. So basically when something drops out of the top 20. So for the period, we're going to go from January 1st, 2023 to today, which is August 9th, 2024. And we're going to run this simulation. And we can take a look at the chart here. You can see that the model, which is the model that we just built, is in red. Our benchmark, which we defined as the S&P 500, is in blue. So you can see that this strategy did underperform the S&P 500. However, all is not lost. It's important to remember that you also have to consider the risk of a particular strategy. If you're someone that cares about downside protection, which most people do, this strategy's maximum drawdown right here is 51.5%, compared with the benchmark S&P 500 at -55. So this was a little bit of a more high quality portfolio. You were focusing only on the largest businesses in the S&P, which gave it a little bit more of a quality tilt. We can take a look at the top holdings. We have 20 of those, which were just rebalanced not too long ago. So right now we've got Apple, Amazon, Broadcom, Berkshire Hathaway, Costco, Google, Home Depot, Johnson & Johnson, JP Morgan, Eli Lilly, MasterCard, Facebook or Meta, Microsoft, Nvidia, Procter & Gamble, Tesla, UNH, United Health, Visa, Walmart, and ExxonMobil. And you can see, as we talked about earlier, the weighting for all of these is roughly 5%. So upon rebalance, it gets rebalanced, back to 5%. We can look at the transactions here. So if we look down here, you can see that the most recent rebalance was as of the beginning of June. So we're selling some of the winners, like Exxon was a winner, Costco was a winner for this particular time frame for that quarter. Tesla was a bit of a loser, so it bought more of that. So you're always rebalancing back to 5%, unlike the S&P 500. We can also take a look at the statistics, the performance by calendar year. You can see how the strategy is done in each year going back to 2003. So there are some years where it underperforms. Actually, the worst year was the very first year in 2003. So if we did what he suggested, which was to start in 2004, performance would have probably been better than this. Looking at the risk metrics, this strategy actually has a little bit of underperformance relative to the S&P, but has the exact same Sharpe ratio and actually a slightly superior Sortino ratio. So on a risk-adjusted basis, the strategy isn't as bad as it looks on the surface. But what if we reran this and put a little coffee can spin on it? The idea of the coffee can is just like back in the Wild West days where they'd put their valuable possessions in a coffee can, bury it in the backyard somewhere, and just hold it for decades. The coffee can with the stock market is basically you buy stocks, or it could be ETFs, and you just basically set it and forget it. So what would happen if we did this in 2003 and we just bought the top 20 market cap weightings at the time, and then we just left it alone and did not rebalance at all? So we can do that here. We're going to change to a starting weight of 5%, and then they're going to drift over time. So we're going to have 20 positions to start, each at 5% weighting. We're going to keep the same universe, the same ranking system, market cap. We're still going to buy stocks when they get into the top 96th percentile. Only this time we're going to not sell anything. So I'm just going to delete this sell rule. We're going to skip over these other strategies. We're going to do the exact same period. And now let's see what happens. Very interesting. So while the strategy of coffee canning the top 20 positions does not outperform the market, it is very close. Just very slight underperformance over this time period. But very interestingly enough, the maximum drawdown is even lower. We also see the Sharpe ratio improved. So if we take a look at the holdings, you can see that just like all coffee cans, you end up where the winners keep winning, and you end up with very large allocations to the stocks that performed the best. This is actually more similar, I think, to how the S&P 500 actually works, in that the big companies are continuing to get bigger and bigger and bigger in the portfolio. Conversely, the losing positions get smaller and smaller and smaller. So you can see that Altria, which was probably one of the biggest stocks 20 years ago, is only worth 0.7% of the portfolio, down from a starting weight of 5%. AIG basically went bankrupt in 2008 and 9. Same thing happened with Citigroup. So you had a lot of positions that did very poorly over this time period, yet the winning positions did so well that they offset that and then some. Here we can look at it again, broken down by year. We also see, just like in the other strategy, big underperformance in the first 3 years, but it's really done quite well since then. And if we look at the risk metrics, this strategy is actually pretty impressive. The Sharpe ratio is higher than the S&P at 0.73 compared to 0.69 for the benchmark. Sortino ratio at 0.97 versus 0.91 for the S&P. And as we talked about before, the max drawdown is quite a bit lower than the S&P. So on a risk-adjusted basis, buy the top 20 market cap weighted stocks and then just don't do anything actually looks like a pretty decent strategy, particularly if you're looking to minimize your downside risk. So thanks for the question. If you have any other ideas for backtesting strategies that you would like to see, leave me a comment in the comment section down below. If you have any comments on this particular strategy, I'd love to hear those from you as well. As always, thank you so much for watching the video, and I will see you in the next one.